The race to regulate stablecoins is heating up, and the UK is determined not to be left in the dust. But here's where it gets controversial. While the Bank of England promises to match the US in speed, industry experts are already raising concerns about the practicality of its proposed rules. Could the UK's approach actually stifle innovation rather than foster it? In a bold statement, Bank of England Deputy Governor Sarah Breeden assured the public that the UK's stablecoin regulations will be operational just as quickly as the US. This comes as a response to fears that the UK might lag behind in the global push to regulate these digital assets. The central bank is set to unveil its framework on Monday, introducing temporary holding caps of $26,087, £20,000 for individuals and $13 million, £10 million for businesses. But here's the catch. These limits, while aimed at safeguarding financial stability, have already sparked criticism from industry players who argue they could be overly restrictive and impractical. At the SALT conference in London, Breeden emphasized the UK's commitment to keeping pace with the US, where the Genius Act, signed into law by President Trump in July, has accelerated stablecoin adoption. Our aim is to ensure our regime is up and running just as quickly as the US, she said, as reported by Bloomberg. It's a fabulous opportunity to work together on this. Paul Howard, senior director at crypto trading firm Winsent, welcomed the timeline, calling it great news and highlighting the UK's leadership in financial services, which contributes over 40% to the national GDP. Given the UK's historical role as a global hub for foreign currency exchange, Howard stressed the importance of safeguarding jobs and economic growth in this sector. And this is the part most people miss. The UK and US are collaborating through a joint task force, launched in September, to align crypto regulations and ease cross-border capital flows. Policy recommendations are expected by March 2026, but the success of this partnership could hinge on how both nations address the concerns surrounding stablecoin limits. Breeden downplayed worries about the holding caps, arguing that they are less of an issue in practice than people might think. She justified the UK's stricter approach by pointing to structural differences in credit markets, noting that US mortgages are funded through financial markets like Fannie Mae and Freddie Mac, while UK mortgages rely on commercial banks. But industry leaders, like Simon Jennings of the UK Cryptoasset Business Council, remained skeptical. Jennings warned that the retail caps could be cumbersome, costly, and potentially unworkable, urging regulators to recalibrate these limits. The Bank of England has hinted that these caps are temporary and could be lifted or removed entirely once concerns about stablecoins' impact on bank deposits and mortgage availability are addressed. However, market sentiment remains cautious. Despite stablecoins currently boasting a market cap above $311 billion, prediction market Myriad suggests that users expect this figure to fall short of $360 billion by next February. Here's the burning question. Is the UK's cautious approach to stablecoin regulation a necessary safeguard, or could it inadvertently hinder the growth of a potentially transformative financial sector? Share your thoughts in the comments. We'd love to hear your take on this evolving debate.